Spotify was the mystery chart we've been showing you all hour. It's on a tear, surging more than 60% this year. And my next guest sees a long runway ahead for user growth, naming it a top pick in media and entertainment. Joining us is Ben Swinburne, head of U.S. media research at Morgan Stanley. As a podcast aficionado, Ben, I'm very excited about this. Do tell, have the podcast economics finally improved enough to make you love the stock?
Well, it's great to see you, Kelly. Thanks for having me on. We've been bullish on the music industry in general for a while, really believing that it's underpriced, undermonetized. I mean, we spend, as Americans, less money today on music than we did in 1999, and that's in nominal dollars, so real dollars down even more. Spotify had not raised prices since it entered the U.S. market in 2011 until late last year. And so, yes, podcasting has become a profitable business for them now for the first time. But really, there's a bigger story around building Spotify from a great product to a great business.
What is that story?
The reason we're so bullish is that in addition to beginning this repricing cycle as the market leader, they've now launched an audiobooks business, which is the first major step, bigger even than podcasting, in sort of driving this business to higher profitability levels. The music business is a good business for them, but most of the economics go to the supply side, the music labels, the artists. As they build out additional verticals, you mentioned podcasting and now audiobooks, it creates additional profit pools that I don't think the market fully appreciates yet. So we are meaningfully above consensus for estimates for next year.
Why are audiobooks such a good business? And is that a moat? Are those margins, that they can protect?
Well, Spotify starts with the most highly engaged listener. I don't know what streaming music service you pay for. You don't have to announce that here.
None. Well, no, maybe YouTube music. We don't really. I'm not a big music person, so it's all about the spoken word. Yeah.
Yeah. Well, Spotify might be right for you because you get 15 hours of free audiobook content now if you take this new higher priced bundle. But they have the most engaged consumers, and they have the lowest churn. Not just of all the streaming music services, but we think it's of all streaming services, including video. So they're taking advantage of that strong user base and engagement level and layering on new services, including audiobooks. Audiobooks has been a pretty small market historically, but the way they've gone to market, about a quarter, roughly, of their users who can access audiobooks have started to. And more importantly, it's allowed them to take price on the service while driving much higher incremental margins that they've seen in the music business.
That's fascinating because anecdotally, I think that people are listening so much more to books than they are reading them these days. It's just much easier. You can do it on the go. You can do it in the car. You can do it in your house, what have you. I mean, there's people like my siblings who will never quit Spotify because it has their playlist that they've built over 10 and 15 years' time. So, I guess that's still the bread and butter. They need to make sure that they get that right and not lose that audience even as they build out these other offerings. I mean, how much profit upside do you see in the next couple of years?
I mean, until 2024, Spotify didn't make money. So this was a business that became a public company in 2018, grew its user base rapidly. I think most investors understand it's got a very strong product, but really we're just at the beginning of the building of a big business from a profit point of view. A lot of tough decisions at Spotify last year on the headcount front, but now taking advantage of their product superiority and taking price, you're really seeing that inflection. So we're at a 20% plus top line revenue growth. And our estimates for next year are double-digit percentages above consensus on the earnings front, which is a combination of revenue growth, but also importantly, operating leverage in the business. So we see a lot of
Well, final question. How much of this is a subscription story versus an advertising story at a time when the ad dollars are shifting around so much? And it's always been said that podcasts aren't profitable enough on there. And I know I keep saying podcasts, but is there an advertising lever that you anticipate, contributing significantly to the upside, or is this still a subscription story?
I think it's subscription, but with a expanding service offering. We called our note yesterday the bundler. Because I think you need to start thinking about Spotify as more than just music. And this is really an app that I think for many of its users is something they're really just not going to cancel. You mentioned playlisting. A lot of investors think, well, the same music is on all services, so aren't these interchangeable? The reality is the majority of listening is on playlists, and a big chunk of that are on playlists that we all as users have programmed. That's an investment that creates real stickiness in the product.
Absolutely.